Let's talk about Roth conversion, and if you ought to consider a Roth IRA, if you ought to consider converting some of your current 401k or IRA into the Roth IRA. There are a lot more factors than just simply plugging in a calculator that says I'm going to be in a lower bracket in the future, so I shouldn't, or I'm going to be in a higher bracket in the future, so I should. You want to consider a multitude of factors before you convert money into the Roth IRA. One of the things that I would suggest is that if it's a question, you're not sure if you should or should not, I have always erred in favor of converting when I wasn't sure. In other words, once I weighed out all the factors and I thought, boy, I'm not really sure how this is going to work out, I generally have at least converted some of the money into Roth. One of the factors that's very important when we're looking at converting IRA to Roth is, what are your children's tax brackets? Are they going to be in higher brackets or lower brackets in the future? Most people who are serious about saving are going to be leaving some money to their heirs. And if that's a high priority, you want to look at if they're in a higher or lower bracket than you. Now let's suppose that you have two children. One is in a high bracket and one is in a very low bracket. If you were to convert to a Roth IRA in your tax bracket, which let's suppose it's high, and then leave that to a child that's in a low bracket, then we've paid more taxes by converting it than we would have if we had given that IRA to a child in a lower bracket. So what we generally suggest is that if we have some IRA assets and some Roth IRA assets, for example, we would leave the IRA assets to the child in a lower bracket, perhaps a little bit more because we know it's going to be taxable, and then we leave the tax-free assets to the child in the higher tax bracket. And what happens is they both end up with a little bit more money at the end of the day. And a little bit more money, I mean maybe 15% more. Well, if it's $1 million, it's an extra $150,000 just by that one small strategy. The other thing you want to consider is, what is your estate tax bracket? If you're in an estate tax bracket, that would favor the Roth conversion very heavily. It's called an estate shrink down. Let's suppose that we have a $2 million IRA and we have a $10 million estate. If we convert $2 million from IRA to Roth and we're in a 30% tax bracket, we probably would be in a 40% tax bracket once you figure state taxes and so forth, $800,000, if you converted the whole thing, would be owed to the IRS in taxes. So you start with $2 million, you pay $800,000 in taxes, and yet you're left with a $1.2 million Roth. Well, the wonderful part about that, if you're in an estate tax bracket, because estate tax brackets are likely to be 45 cents on the dollar going forward. That's the anticipation at this point. That being the case, shrinking that IRA from $2 million to $1.2 million on that $800,000 saved you over $333,000 in estate taxes, or I should say saved your heirs $333,000 in estate taxes. So instead of them inheriting a $2 million IRA, they inherited a $1.2 million IRA. But if they had inherited the $2 million IRA, they would have paid estate taxes of 45% instead of paying estate taxes on $1.2 million of 45%. And then of course we have the huge difference of the $1.2 million is income tax free and the $2 million was income taxable. So you want to definitely look seriously at converting money from IRA to Roth if you are in an estate tax bracket. The other reason you might convert IRA to Roth is if you believe that the stock market or whatever you're investing in has the potential for great upside over the next 12 or 18 months or whenever your tax filing date is with extension. So suppose it's January 1st and you want to convert some money to Roth and it does fantastic after you convert it. Well, you keep it because all that growth you just made was tax-free. On the other hand, suppose that the investment did not turn out as you thought it would and it went down. Well, now you've converted, let's say, $1 million over to a Roth and it's now worth $600,000 because the market went down. Well, you paid taxes on $1 million, but it's only worth $600,000. Well, that's not a very good deal. So the government lets you do what I call a mulligan. It allows you to recharacterize back to your tax filing date that $600,000 and call it a Roth. or call it a traditional IRA again. You wait 31 days and you just do the same thing over again. You can convert it now to a Roth again because whatever you invested in is that much better of a deal potentially. So when you're converting from the IRA to the Roth, don't just look at the IRA calculator that asks you if you're going to be on a higher bracket. Look at the diversify by tax bucket strategy. Determine what type of diversification you have by the tax-free, the currently taxable, and the tax-deferred bucket. Look at your estate and your heirs and consider all those factors and balance each of those before you convert from IRA to Roth. For many people that we've seen, it's been a fantastic strategy. I've done it myself. A lot of our clients in the past have done it, and we know that they've been very pleased with it. The one last thing that I would suggest is there are investments that you can make when you convert from IRA to Roth that can potentially offset the taxes or some of the taxes that you owe on that conversion. One of the things that we've used in the past is what we call intangible drilling costs. There is a code in the Internal Revenue Code that allows for intangible drilling cost tax deductions when you invest in homeland drilling. Many of our clients have converted, for example, $1 million from IRA to Roth, and that $1 million becomes taxable, and they may owe $400,000 in taxes. But $500,000 in an oil and gas type of investment can all but wipe out that entire tax liability. If somebody fundamentally is comfortable with an oil and gas drilling program and the risks that are associated with that, that's one way to offset some of those taxes, or in some cases, as we've seen it, all of the taxes of that conversion. And then depending on the merits of that oil and gas investment for a reasonable return on investment. So many factors to consider before you convert that IRA to Roth, but certainly something that should be explored with this and many other factors in mind.